Welcome to the Deep Dive.
Hey there.
So today we're digging into a recent earnings call. It's for Vital Energy Incorporated, their first quarter 2025 results.
That's right. And our plan, is to unpack what they said, what happened in Q1, what's their outlook, and what details really jumped out is important.
Okay, let's get right into it then. What was the big picture from Vital Energy for Q1?
Well, the headline really is that they had a solid quarter, actually came in better than the street expected.
Better than expected is always a good sign. Where did those wins show up, like in the numbers?
The big one was debt reduction. They knocked down their net debt by $135 million just in Q1.
Wow. Okay. $135 million.
Yeah, and that was helped by their adjusted free cash flow. That also beat the consensus estimates.
So strong cash flow driving that debt pay down makes sense. Any other boosts to the cash gain?
Definitely. Their hedges, they kicked in over $20 million to revenue.
Okay.
And they sold off a non-core asset, too. That brought in another $20.5 million.
So a nice mix then. Operations, hedges, and selling something off. How are the core activities? Drilling, getting oil out of the ground.
Capital spending and production levels. Pretty much right where they expected them to be for the quarter.
All right.
And they made a point of saying costs are clearly moving in the right direction. Downwards.
Costs heading down, always good to hear in this business. Now, I remember late last year they talked about shifting strategy, right? Less buying stuff, more focusing on what they already have.
Exactly, that pivot from acquisitions to optimizing their assets. And you can really see that starting to play out in Q1's operations.
How so?
Well, the Q1 volumes came mainly from new wells they brought online. 23 wells in total. Most of those, 21 actually, were in the Southern Delaware Basin.
And I thought I saw something about them getting faster at drilling.
Absolutely. Continued gains in drilling efficiency. It actually let them pull some spending forward into Q1 because they were working faster.
Pulling spending forward.
Yeah, they even set some cycle time records for both their 2-mile and 3-mile wells. Yeah. Drilled them faster than ever.
Setting records. Okay. That sounds like it should help the bottom line. Does it translate financially?
Direct impact, yeah.
Yeah.
They reported a 30% year-over-year improvement in capital efficiency in the Delaware Basin.
30%?
Yep. Getting more, well footage drilled for the same amount of money compared to last year.
That's a pretty substantial jump, 30% year over year. Are there specific technologies helping with that?
A big one they highlighted is Simoprak technology for completions.
Simoprak.
Yeah. They expect to use it on like over half of all their completions in 2025. And in Q1, they said it went really well. Better than expected, actually delivered completion packages ahead of schedule.
Ahead of schedule, okay. That points to good execution. And they also mentioned some interesting well designs, like J-hooks, horseshoes.
Exactly, using these leading edge well shapes, J-hooks, horseshoes. The idea is basically to maximize the value from their land, get to the best rock more efficiently. They've already drilled their first couple of J-hook wells. Said it proves the concept works. And they think that technique alone could lower the break-even price for 135 specific wells by about $5 a barrel.
Just changing the shape of the well path lowers the cost by $5? Wow. Shows how much engineering matters.
It's all about optimizing, yeah. Getting more oil out cheaper.
Okay, let's talk more broadly about costs. They said things were moving the right way. Any specifics?
Yeah, they gave some numbers. Lease operating expense, LOE.
Yeah.
That's the day-to-day cost of running the wells.
Right.
That came down about 5% from Q4 last year. It was running at like $121 million a quarter. Now they expect it between $110 and $115 million per quarter for the rest of 25.
Okay, a decent drop in those ongoing costs. What about corporate overhead, G&A?
General and administrative.
Yeah.
Excluding their long-term incentive plan costs,
Mm-hmm.
it was just over $23 million in Q4. They're projected to be under $22 million a quarter going forward this year.
So cost down operationally and at the corporate level. Good. Did they mention anything about like steel tariffs or general inflation in the oil field?
They did. They said any initial price hikes they saw from things like tariffs have basically been more than offset.
Oh, how?
By getting concessions from service providers. They describe the service market as softening.
Ah, okay. So less demand for rigs and crews is helping them negotiate better prices. Makes sense. So given the strong Q1, these cost improvements, how are they feeling about the whole year?
Sounded quite confident. They said Q1 gives them strong confidence in the full year outlook.
Right.
So they're reiterating their guidance midpoints for capital spending and production for the full year. But importantly, they lowered their operating cost guidance for the year.
Okay, hitting the production targets but doing it cheaper. Sounds good. What's giving them that high level of confidence?
Few things they pointed to. First, the wells they plan to complete in the second half of the year, they expect really high returns from those. They're focusing on areas with low break-evens, around $45 WTI.
$45 break even? That's pretty low compared to where prices are now.
Gives them a lot of breathing room.
Yeah.
Second, they see production ramping up significantly later this year. Lots of wells coming online in Q3. They even floated the possibility of setting a company production record in Q4.
A record in Q4, that would certainly help cash flow finish the year strong. And the hedging, that plays a role too, right?
A huge role. That's the third factor. Their hedge book is really solid. For the rest of 2025, 90% of their expected oil output is hedged at $70.61 WTI.
Locking in over $70 for almost all their oil, that gives a lot of certainty.
It really does. Protects the downside. So based on all that, they're projecting about $265 million in adjusted free cash flow for the full year.
Okay.
And hitting a net debt reduction target of $300 million. That includes the money from those asset sales they already did.
$300 million off the debt in 1 year. That's a big move in deleveraging. What does all this efficiency stuff mean for how much drilling inventory they have, the quality of it?
That was another key point. They said their asset quality gives them good options. Specifically, they mentioned a 300% increase in the amount of completable lateral feet they have that breaks even below $50 WTI.
300% increase. That sounds huge. How do they get a jump like that?
That's where the tech comes back in. Those J-hooks and horseshoes again. They explain that by using these shapes, they can combine laterals. It might mean fewer actual wells drilled in an area.
Okay.
But crucially, they don't reduce the amount of reservoir they can actually develop. So they're improving the quality, the economics of their inventory, making each foot drilled more valuable, lower cost.
So fewer wells, same resource access, lower break-evens. Got it. That really changes the efficiency picture long term.
Definitely enhances their flexibility, lets them pick the best projects, even if prices wobble.
Speaking of wobbles, they did say they're not immune to market challenges. How are they set up to react if things change?
They stress their flexibility, and a key part of that is their contracts. They specifically structured things so they have no rig or completion contracts that go beyond early 2026.
So all the big service deals are up for renewal pretty soon. That gives them leverage if the market stays soft.
Exactly. They can adjust activity, renegotiate rates. They also said they're committed to being free cash flow positive in 2026.
Okay.
And they're doing a full review of costs. Again, looking for more savings, ways to boost margins. The clear focus, they said, is maximizing cash flow, paying down debt. That's how they see building long-term value.
Makes sense. Prioritize the balance sheet after that period of growth. Okay, the Q&A section of these calls often has some gems. What came out during the analyst questions?
Yeah, there were some good details. One was about their corporate break-even price. Right now, they said it's $57 a barrel WTI.
$57 today.
Yes, but they talked about how that could come down. If service costs drop, say, 10%, which one report suggested might happen in a sustained $60 oil world,
Okay.
that alone, which is maybe $90 million a year for them, could get the break-even down to around $53.
Right.
Then add some more of their own LOE and G&A cuts. They think they see a path potentially closer to $50 a barrel.
So a potential $7 reduction in the corporate break-even, combination of market help and internal work. What else?
Did they give more color on the LOE savings?
They did. More on the self-help initiatives. They mentioned the point acquisition assets are performing really well after integration. So, actually, there was a $6 million positive adjustment in Q1 related to prior periods.
Okay. So that made the reported Q1 LOE look a bit lower than the actual run rate?
Exactly. The true run rate in Q1 was closer to $110 million, not the $103 million reported once you back out that adjustment.
Got it. So run rate $110 million, but they forecast maybe $114, $115 million later in the year. Why the slight uptick? Mainly just higher water volumes they expect as overall production increases. But they think the savings they're getting on fixed costs and workovers will stick.
Right.
They mentioned specifically things like fewer failures of their ESPs, the electric pumps downhole, and lower costs for well workovers in both the Delaware and Midland basins.
Fewer pump failures, cheaper fix-it jobs. That directly hits LOE. Makes sense. Any more in 2026 beyond just being cash flow positive?
Yeah, they gave a bit more shape to it. They're estimating roughly flat production and capital spending in 2026 compared to 2025.
Flat year over year?
Yeah. And they specifically called out expecting significant savings from those service contracts expiring, mostly late 25, early 26. How exactly things track quarter to quarter in 26 depends on, how busy they decide to be in the first half.
Okay, stable plan, potential cost tailwinds. And on that service market softening, are they actually seeing chances to get better rigs or crews now?
They are. They see it as a chance to high grade, as they put it, get better quality for potentially lower prices.
Any examples?
Yeah, they said a recent rig contract they signed came in about 20% below their current fleet average cost.
20% lower. That's real money.
Definitely shows those lower rates are becoming available as the older, pricier contracts end.
Okay. There was also something about non-cash impairments. Sounded like accounting jargon?
It is, mostly. They explain that if oil prices stay around where the futures market implies the strip price, they'll likely have to book these non-cash impairments.
Meaning?
It's an accounting write-down based on SEC rules that look at historical prices. Could be a couple $100 million next quarter, they estimated.
Okay.
But they stressed it's just an accounting thing based on price formulas. It does not mean the oil and gas is gone or that the assets are suddenly worthless operationally. Just a paper entry.
Right. Important distinction. Paper entry, not lost reserves. And that asset sale they did in Q1. More detail on what that was.
Yeah, they said it was a gassier asset.
Wow.
About 200 barrels a day of oil, but 1,300 barrels of oil equivalent, or BOE total. They sold it because basically it didn't fit their development plans. They didn't see much future drilling potential from there. But the buyer did. So they got cash, paid down debt faster, and it didn't change their full-year guidance since they'd already factored its production in.
Smart move. Sell something you weren't going to invest in anyway, use the cash. Anything on a WAHA basis? That's the West Texas price difference, right?
Yeah, WAHA, there's the main Cushing hub. They said basis was better in Q1, almost 40% of the Cushing price, which helped. And they think if activity slows down in the region, that basis could tighten even more, which would benefit them. They use swaps and hedges to manage that risk anyway.
Okay, that covers a lot of ground. From the headlines down to the Q&A details on Vital's Q1 call.
Yeah, we hit the beat on expectations, the debt progress, the efficiency gains from tech and technique, their confidence for the year, the path to 2026, and those key analyst questions on break-evens, costs, and asset sales.
So why does wading through all this detail from one earnings call actually matter for you, the listener?
Well, because it shows you what's really going on under the hood, right? It's not just the final numbers.
Yeah.
This transcript shows a company actively pulling levers.
Like what?
Like aggressively managing costs, using tech like Simoprak and those shaped wells to get more efficient, and strategically using hedges to lock in cash flow when the market's jumpy.
So it helps you understand how they're navigating the current environment, how they're trying to build value, not just what the results were. Gets you closer to their actual strategy and execution.
Exactly. It's the why and the how, not just the what.
All right. So summing up, we saw Vital Energy put up a strong Q1, make real progress on debt and costs, and really highlight these operational improvements they think will drive value. That flexibility they have with contracts ending soon, plus growing that low break-even inventory seems key to their plan for next year and hitting that sub $50 break-even goal.
Yeah, a clear focus on the balance sheet and optimizing what they've got.
So here's something to chew on after this deep dive. They've laid out this path towards potentially getting under a $50 corporate break-even. And they've got all these service contracts expiring soon, giving them flexibility. How much does hitting that sub $50 number really de-risk their plans? If they could consistently make money, even if oil dipped into the low $50, maybe high $40, what would that kind of resilience allow them to do strategically compared to competitors who need higher prices?
Yeah, it definitely makes you think about how they might be positioned differently in various price scenarios down the road.
Indeed. Well, thanks for joining us for this deep dive into Vital Energy's Q1 2025 earnings call.